Good morning to you, Mr. Hufeld. When you look at some of the negative rates that we're seeing in Europe that could be further pushed lower by the ECB action possibly in September and October, what does it mean for banks? They've been saying they're too low, but could you actually see it transforming into a financial stability concern for the German banks?
Well, absolutely. Negative rates are already a real burden and strain on the P&Ls and balance sheet of European banks, German banks in particular. The relative impact on German banks is by far the highest. It goes without saying that if such negative rates would be further lowered, further revenues of the bank would evaporate just like that. So banks have to deal with that challenge. I'm not sure I would put that on a level as a financial stability risk yet. But individually, for a whole number of banks, it is a massive challenge.
Do you worry about Deutsche Bank in particular? Are we seeing a financial stability issue for them if we see further negative rates?
Well, I don't comment on individual banks. It's most certainly a challenge for all major banks in particular, who have very large volumes which have to be deposited with the ECB. So yes, absolutely, it does cover all banks, including Deutsche Bank.
Okay, are banks strong enough to weather an economic downturn? I'm trying to understand from you, Mr. Hufeld, about what's the turning point, right? How much more negative rates can they impact? Is there a figure that you have in mind? And if we see a recession, how will the banks cope with that?
Well, indeed, we already see that risk cost, which tended to be a friend in the last couple of years due to the unusually positive economic environment, where in many cases risk reserves were actually negative in the sense of enhancing the P&Ls. That, of course, has turned now. We do see increasing early signs of recessionist tendencies. It's too early to tell whether it will really go into a recession, but most certainly we see a strong impact. Almost all banks across the board, rightly so, have to increase their risk reserves, and that's exactly what we are seeing happening. It's indeed it works like a double whammy on any particular bank's balance sheet, that at the same time they have to increase risk reserves. They may have to pay a higher cost on negative interest rates with the ECB. They have to invest on new technologies and digitalization, on IT security. So it's a pretty tight mixture of challenges the banking system has to cope with.
Yeah, which is why in the past you said that they really, really need to tackle costs. Has Deutsche Bank done enough on costs? No. All banks, including Deutsche Bank, have to do more, that's for sure. But I suppose, let it be Deutsche Bank, let it be most of the other banks, they have got the message. And it's not just about cost in a very plain sense. It's as much about reviewing the setup of the business models. There's too much complexity in many business models. There are too many particularly business lines being kept up which are not really profitable, and the lesson we have to learn is that even major banks can't stay in particular business lines if you don't move up to number 3 or 5 in the global rankings, because you won't make any profits on those businesses. So there has to be more rigidity in reviewing the setup of the business models. So it's more than just doing what you do more efficiently. That's of course part of it. It goes deeper than that. It has to review how you do things to start with and how your business model is designed.
So Mr. Hufeld, talk to me more about that business model. Do you slim down, focus on what you're really, really good at, or bulk up and try to become a global player?
Well, that's exactly my point. You have to be honest to yourself. What exactly can you do? If you're a local retail player, you should stay that. You should review the range of products you are offering. Let's assume you're offering 100 products. Possibly you could serve your customers very well with 50 products. And let's not forget, there are many younger, new attackers and startup or big tech entrants into financial services who are exactly attractive to customers because they are simple. I don't think that customers reward complexity per se. So depending on who you are, a global player or a local retail player, you just have to be quite focused on strengthening where you're good at and getting rid of what you can't support.
Loan loss provisions are rising at German banks, Mr. Felix Hufeld. Is that because banks were just too generous with their loans?
Too generous with, I'm sorry?
With their loans, in granting loans. Were they giving too many loans out?
I don't think so. I mean, of course, Germany is a high-wage country, that's for sure. But I think it's more driven by complexity of product lines, of business lines. I don't think it's primarily and necessarily driven by the exact level of wages. But of course, to the extent you are redesigning processes and you can create the same value with less people, you should do it with less people. But I don't think that the general wage level in our country is the primary driver.